All right, so let's dive into something that I'm sure is on a lot of our minds if we're, into the stock market at all. Valuations. And specifically, are they too high? Should we be worried? And the piece we're going to look at today to kind of guide our deep dive here is an article from mapsignals.com called Stock Valuations Are High, and That's Perfectly Fine. And this is from January 13th, 2025. So, we've all heard the doom and gloom, oh, the market's going to crash, valuations are too high. So is that true? Are we all going to, lose all our money? Or is there more to the story? Let's find out.
Yeah, and what's interesting about the article is that it kind of challenges that fear that, high stock prices automatically equal a bubble about to burst.
Yeah.
And it kind of argues that instead of freaking out, we should look at, the underlying factors driving those valuations.
Okay, so what's actually going on to make those valuations what
Yeah.
they are? Okay, so the article starts off by talking about how the S&P 500's forward price to earnings ratio, PE ratio for short, is currently above its historical average. And, just a reminder for everyone, the PE ratio is basically how much investors are willing to pay for each dollar of a company's earnings. So a higher PE ratio generally means that people are, more optimistic about future growth. But the article says, hold on, we got to dig a little deeper here.
Yeah, because, if you just look at that number in isolation, it could seem kind of scary.
Right.
But they argue that the S&P 500's PE ratio being so high is largely due to this small group of mega cap tech companies. And some analysts are calling them the Magnificent Seven, and they're just seeing crazy growth.
So is it fair to say that the market is being cropped up by just this handful of high-flying tech companies?
Yeah, that's what the article's kind of getting at.
Hmm.
And so their PE ratios are significantly higher than the rest of the market, which, on the surface could be alarming. But they make this point that these companies are expected to deliver earnings growth of around 21% in 2025, compared to
Yeah.
13% for the remaining S&P 4993 companies.
Oh, okay, so that's a huge difference. So their valuations might actually be justified
Mm.
because they're growing so much faster than everyone else.
Yeah, exactly. So it's not just that the prices are high, it's that their earnings are expected to really catch up.
Okay, so their growth isn't just hype, it's actually happening.
Right.
Okay, so the article's central thesis then is that valuations are high because the underlying fundamentals are strong.
Mm-hmm.
And to support this, they kind of dive into three key macroeconomic factors.
Yeah, and I think this is where it gets really interesting because it helps us understand, what's going on beneath the surface.
Yeah, let's unpack those factors. So the first one they mentioned is economic growth. Now, I know valuations tend to rise when the economy is doing well,
Uh-huh.
but can you kind of elaborate on why that is?
Sure. Yeah, so basically when the economy is growing, companies generally are seeing higher sales and profits, which makes their stocks more attractive to investors, which drives up prices and therefore valuations. And then, conversely, during recessions, valuations tend to fall sharply
Yeah.
because investors get more risk averse.
Oh, okay. So they're oh, things are bad. Let's get out of here. Right.
Exactly.
So right now, are we kind of in that sweet spot then where recession risks are considered low? So
Yeah, the article seems to suggest that we might be. And they point out that we're in the early stages of an economic cycle, which historically has been favorable for stock valuations. They even say during these early cycle years, PE ratios typically expand by an average of 2.7 points.
oh, wow. So that's good news, potentially.
Yeah, it seems
Okay, so
so.
strong economic growth is the first factor they're saying. What's the second?
Okay. So the second one is the Fed's monetary policy. And while they've been raising interest rates to, fight inflation, the article suggests that they might actually start cutting rates soon.
Now, wait a minute. I thought raising interest rates was supposed to be bad for the stock market. How could cutting rates be a good thing?
Well, it comes down to how interest rates affect borrowing costs for companies. So when rates are high, it's more expensive for companies to borrow money, which cut into their profits
Yeah.
and then make their stocks less appealing. But when rates are cut, borrowing becomes cheaper. So it can potentially boost those profits and then make those stocks more attractive to investors again.
Okay, so even though the Fed has been raising rates, the article is suggesting that future rate cuts could actually support higher valuations.
Exactly.
Wow.
And they even have this specific data point. They say that the current difference between the Fed funds rate and CPI inflation is higher than its historical average. So it kind of suggests that there's room for the Fed to ease up on rates
Right.
without causing inflation to go totally crazy.
Okay, that's super interesting. So we've got the healthy economy, we've got the potential for a more friendly Fed, I guess. What's the third factor that they highlight?
The third one is strong earnings momentum. And basically, this just means that companies are experiencing solid earnings growth, which, generally means higher stock prices. The article says that the S&P 500 is projected to see earnings growth of like 14.8% in 2025, which is significantly above its long-term average.
Okay, so these companies aren't just resting on their laurels, they're actually
Yeah.
like delivering. So that would justify those higher valuations.
Exactly. And they emphasize that this earnings momentum is particularly strong in the tech sector, which kind of helps explain those high valuations of like the Magnificent Seven that we talked about earlier.
Yeah, okay.
So it's not just like hype, it's backed by actual performance.
Yeah, they're walking the walk. Okay, so we've got the three factors, the solid economy, the potential friendly Fed, and this booming earnings environment. It sounds like a pretty good setup for stocks.
Mhm.
But like, is there any historical data to kind of back this up?
Yeah, there is actually. The article points out that since 1980, whenever the U.S. has experienced above average earnings growth, and the Fed has been easing monetary policy, which is exactly the situation we're in right now. The
Mhm.
S&P 500 has seen an average annual PE expansion of 9%.
Whoa. So historically, when these conditions are in place, investors are basically willing to pay even more for each dollar of earnings,
Yeah, basically.
which leads to higher valuations.
Mm-hmm.
Cool.
And what's even more interesting is this scenario is played out like 91% of the time, so it's not a guarantee. But based on historical data, it seems like the current market conditions suggest that higher valuations might not be a red flag, but more of a reflection of like strong fundamentals.
Okay, so the data seems to support their argument that high valuations aren't necessarily a bad thing. But, I'm also a bit skeptical. Like, what if things don't go as planned? What are some of the risks that could, like, derail this seemingly rosy outlook?
Yeah, that's a great question. And, it's important to consider both sides of the coin. And I think in the next part of our deep dive, we can explore some of those potential risks and challenges to the bullish case laid out in this article.
Okay, I'm ready for that. It's easy to get caught up in all the, excitement about a potential bull market. But it's important to remember that no investment is without risk. So let's put on our, skeptics hats for a minute and think about some of the potential challenges to this, like, optimistic outlook.
Yeah, I think that's really important. The article paints a pretty positive picture, but things could definitely go differently than predicted. The market, rarely moves in a straight line.
Right. Okay, so let's start with interest rates. The article suggests that the Fed might cut rates soon, which could be good for those valuations. But what if inflation stays high and the Fed is forced to keep rates higher for longer, or even raise them further?
Yeah, that's a big risk to consider. If interest rates stay elevated or continue to rise, it makes it more expensive for companies to borrow money, which can hurt their profits, and then potentially lead to lower stock prices.
And it's not just company profits, right? Higher interest rates also make bonds more attractive.
Exactly. So investors are always looking for, the best return. And if bonds start offering higher yields, we could see some money move from stocks to bonds.
Okay, so that's something to watch for sure. Now let's talk about the economy. The article highlights strong economic growth as like a key driver of those valuations. But what happens if that growth slows down? What if, like, consumer spending weakens or businesses become less optimistic?
Well, those contained recession risks that we talked about
Mm.
could become not so contained. Recessions can definitely have a big negative impact on evaluations. Investors get scared, companies face declining profits.
Right, it's like that fear factor kicks in.
Exactly.
And even a mild slowdown can create uncertainty.
Yeah, and make people hesitant to invest.
Okay, and remember all that impressive earnings growth we were talking about. What happens to those projections if the economy takes a hit?
Yeah, earnings projections are often based on assumptions about the future. And if things turn out worse than expected, earnings could fall short, which would put downward pressure on prices.
Okay, so we've got interest rate risk, economic slowdown risk. Those are two big ones. Anything else we should be keeping an eye on?
Well, geopolitical events are always a wild card.
Hmm?
Wars, political instability, trade disputes, all that stuff can create a lot of volatility.
Yeah, those are the headlines that can really keep you up at night.
Yeah, for sure. And then there's also just like the inherent risk of a market correction.
Yeah.
Those sudden drops of 10% or more. And those can happen even when the economy is doing well.
So it's like the market needs to take a break every now and then.
Yeah, you could say that. And they can be driven by all sorts of things. Investor sentiment, technical factors, sometimes just too much optimism.
Right, so even if the fundamentals are solid, the market can still throw us a curveball.
Exactly. Risk is just part of investing. but I think it's important to maintain a balanced perspective.
Okay, so we've gone from a fairly optimistic outlook
Yeah.
to like a whole list of things that could go wrong. Starting to feel a little overwhelmed.
Yeah, I can understand that. But remember, investing is about weighing those potential risks and rewards. And, the article we're discussing is presenting a bullish case, and they do have some compelling data to support that.
Okay, so how do we as investors make sense of all this? How do we navigate this and make good decisions?
Yeah, that's the million-dollar question. And there's no easy answer. Everyone's situation is different. But I think there are some general principles we can keep in mind.
Okay, I'm all ears.
So first of all, remember diversification. Don't put all your eggs in one basket. Spread your investments across different asset classes, sectors, geographic regions. It helps to reduce your risk. Because if one area does poorly, it doesn't wipe out your entire portfolio.
So don't get too attached to any one stock or sector.
Right, exactly. Diversification is all about managing risk.
Okay, what else?
Another crucial thing is to only invest money you can afford to lose. The stock market is volatile, and there's always a chance you could lose some or even all of your investment. So make sure you have a solid financial foundation before you jump in.
So pay down high-interest debt. Build up that emergency fund.
Exactly.
Make sure you have a cushion.
Mm-hmm.
Okay, got it.
And then finally, remember that investing is a long-term game. Don't panic and sell everything when the market dips. Focus on your goals. Stick to your plan.
So patience and discipline are key.
Yeah, exactly. Ride out those short-term fluctuations.
Yeah.
And focus on the long-term growth potential.
And if you're ever feeling lost, talk to a financial advisor.
Yeah, that's always a good idea. They can help you create a plan that's right for you.
Okay, so we've covered the potential upsides and downsides, and we've got some great advice on how to navigate this market, but I feel like we're still missing something.
Yeah, I think you're right. We've talked a lot about, valuations being driven by economic growth, earnings, momentum. But what about the companies themselves? What are they doing with all those profits? That's where it gets really interesting.
Okay, I'm intrigued. Are they hoarding cash like dragons, or
Mm-hmm.
are they actually putting it to good use? Let's find out. Okay, so we've talked a lot about like the big picture stuff, but now let's like zoom in on the companies themselves. Because, ultimately their decisions are what's going to shape their future and their stock price.
Yeah, and it's interesting to look at how they're using their profits. It kind of tells you what their priorities are and what their plans are for the future.
So let's talk about that. What are some of the ways that companies are using their profits these days?
Well, they've got a few options. They can reinvest in their business, they can buy back their own stock, they can pay dividends, or they can just hold on to the cash.
Okay, so let's break those down, starting with reinvestment.
So companies that are confident about the future are more likely to reinvest their profits, put that money back into the business.
Yeah, makes sense.
This could mean investing in research and development, expanding into new markets, or even acquiring other companies.
So they're like planting seeds for future growth
Exactly.
and hopefully bigger profits down the road.
Right. And that can help justify those high valuations.
Okay, so that's reinvestment. What about stock buybacks? We hear a lot about those.
Yeah, stock buybacks have become pretty popular. Basically, the company uses its profits to buy back its own shares, which reduces the number of shares out there. And that can increase earnings per share, which makes the stock look more attractive to investors.
So it's like they're giving themselves a vote of confidence.
You could say that, but there's also some debate about whether buybacks are always a good thing. Some people think companies should be using that money for other things, like investing in growth or paying their employees more.
Right, so it's a balancing act.
Exactly.
Okay, and then there's dividends.
So some companies choose to pay dividends, which means they distribute a portion of their profits directly to shareholders. This can be a good option for investors who are looking for income, like retirees, for example.
Yeah, it's like getting a little reward for owning the stock.
Exactly.
Okay, and then the last option is just holding on to the cash.
Yeah, some companies might be hesitant to spend their profits. Maybe they're uncertain about the future, or they're waiting for the right opportunity, or they just want to have a safety net.
Makes sense.
But, holding too much cash can also be a sign that a company isn't using its resources effectively.
So as investors, how can we tell which companies are making the best choices with their profits?
Well, that's where you got to do your homework. You got to look beyond the headlines and really dig into their financial statements. You want to understand their capital allocation strategy, their investment plans, their long-term vision.
So it's not just about the numbers, it's about the story behind the numbers.
Exactly. A company's true value is based on its ability to generate profits over the long run. And understanding how they allocate their capital can give you clues about their strategy for doing that.
Okay, so we've explored those big picture factors, we've talked about the risks, and now we've even looked at how companies are using their profits.
It's been a pretty thorough deep dive.
Yeah, and as always, we're coming up with more questions than answers.
That's how it should be.
So to wrap things up, I guess the key takeaway is, when it comes to investing, knowledge is power.
I think that's a great way to put it.
So keep learning, keep questioning, and keep exploring. And remember, investing is a marathon, not a sprint. Thanks for joining us on this deep dive into stock valuations. Until next time.